Yeah, so the last 6 months have been a period where generally there's been increasing optimism around economic growth around the world. We've seen certainly the strongest sector for us has been something like the technology sector. So we're seeing the ongoing trends that have been driving the market for a few years. Data, cloud adoption, so the storage of data by businesses increasingly kind of off-premise, have been driving some of the big investments in the portfolio. The semiconductor space and the processing of data, that went through a bit of a soft patch a year and a half ago, and that's starting to come back, and we've seen a lot more optimism there again. We've seen some resolution on, or hopefully resolution around trade between the US and China. And so, again, that's been positive for market sentiment. And maybe as importantly, we've seen quite a lot of central banks around the world easing policy. So we've seen some interest rate cuts in a number of countries. And again, equities tend to react quite well to that because it suggests future growth will be better. So that's certainly been strong. So markets have been stronger. But also what's quite interesting for us is some of the more defensive areas are also doing well. So pharmaceuticals particularly has been a strong performer. Low valuations, quite a lot of innovation in a number of the stocks we own. And then also areas like utilities. So again, we're seeing increased enthusiasm around this idea of an energy transition being potentially good for people who invest in the electricity grid and providing solutions for lower carbon future. So actually quite a broad range of themes driving the portfolio over the last 6 months. So from a trust positioning, we have relatively large weights in the technology space and the pharmaceutical space. There's a lot of innovation in both. You have to be careful of which stocks you choose, but we still find interesting valuations there and good trends. Probably the two controversial ones that are very cheap as sectors, but at the moment are not seeing any kind of enthusiasm towards them from investors' point of view, in the light of what might be a pickup in economic growth again, are the financial sector and the energy sector. So, there are a lot of companies within those sectors that are good companies, very strong free cash flows, good dividends that are trading at low valuations. So we do have investments there, and they have been some of the laggards over the last year. And I'd say they're probably the area that has the most potential for upside if we do get more confirmation that economic growth is stabilizing and maybe even picking up around the world. The headlines at the moment are more about kind of downgrading of growth expectations, but I think people have to remember where we came from midsummer last year. People were very, very pessimistic on the outlook for world growth. People were more minded that there was, the Federal Reserve was tightening, the trade war was in full flow. So I think there's room for optimism there. We maintain a diverse portfolio, but that gives you some ideas of some of the sectors which are currently doing well, which we think can keep going, and other sectors which we hold where maybe they're future outperformers. So the most notable thing over the last year that we've done is issue some additional debt in order to buy more equities. We did that around Easter time, and we did it with long-term debt to take advantage of these very low interest rates. And so we've invested in a number of stocks across the portfolio. I wouldn't say we've suddenly decided to put it all in one sector, but it's a general indication that we felt there was a lot of value in the portfolio on a long-term basis. So definitely not a 6-month or 1 year indicator of market direction, but more just the yields available and the valuations available on good quality businesses were attractive for us. So that's the biggest thing probably we've done is adding some leverage.